Good evening, everyone, and a very warm welcome to all of you for this Auto Trader webinar. This webinar is basically on the index trading part. We are conducting the first session today, and the stock session would be on Saturday at 12 p.m. Do join us for the stock session if you are interested in stock trading through Auto Trader. And before I start the webinar, I would like to thank you for subscribing the Auto Trader and be a part of this extended research family. We do call it as an extended research family just because we feel that Auto Trader has a lot of research inputs, a lot of potential uh, to really make you a trader, make you an investor, whatever you need. We are there to deliver to you through Auto Trader. Whatever be your research needs, we are always there to help you out. So, as today's topic is market analysis, so we will look into the market analysis part, whatever uh, is in the Auto Trader, which allows you to really do a proper research on markets and then place your orders. I will discuss it thoroughly in detail. I will go little slow because I understand that there are lot many people in this webinar who are not really well versed with the terminologies, or they need a basic training sort of a thing right from the scratch. So before I go any further, I would like to brief you on what you can expect through Auto Trader. So as you can see on my screen, Auto Trader has research inputs and screeners to help you identify stock trend and market trend. So we are not giving you any straight calls as of now, and we will not in future also, because we want to inculcate a sense of learning, sense of belongingness. So we are giving research inputs to you, and we will help you analyze those research inputs. It's not like we have given you certain research inputs and that is it. We would be giving you proper training, proper support, as we are doing right now, and try to support you in at every point. This software works beautifully on every platform, be it mobile, laptop, tablet, desktop. We do recommend that Firefox be your preferred browser, just because it has a compatibility which is at par with any best browser. Even if you want to try other browser, it works perfectly well, but Firefox is much more stable in comparison to others, so we recommend that thing. As far as the structure of the Auto Trader goes, there are two parts to it. One deals with the stock analysis, and we have only catered to FNO stock just because we want to give you a proper 360-degree analysis when we are combining the derivative analysis with the technical analysis part. Stock analysis basically has technical analysis when we talk about its core analysis. Okay. And when we come to the market analysis, it is more to do with derivative analysis or the OI analysis or the PCR analysis, whatever you may call it. But it is quant analysis and not the just the technical price action kind of a thing, because we believe that lot more complex information is being delivered on option part, and future part is relatively easy to understand. Basically, the option part is little harder to understand. That is why we will concentrate much of our energy in understanding the option part. And when we combine the future analysis, it gives you a complete derivative analysis. So that's the basic few points I want to discuss with you for the auto trader. Coming on to the features of auto trader, by now you must have known that to use this software, you don't need any technical analysis knowledge. Even if you have zero knowledge on technical analysis, that is okay with you, because through auto trader, we believe that output driven analysis is much more important than the basic input analysis. So the second thing which we focus on is that we have given certain spaces to every trader, investor, every participant in the market through this software. So anyone who is an investor will not feel left out. And even if you are a stock option trader, then also there is something or the other for you to really rely on. Apart from that, index trading or your intraday cash trading is anyways is an integral part of auto trader. Third thing, we have kept around 9 to 10 screeners, which I think you must have looked at, but we will be covering that particular screener section later in this session, or on the 18th when we discuss the stock part. Fourth and important thing, by now many of you have joined our research support channel, which is available free of cost to our paid subscribers on Telegram for live inputs. Live inputs is that what we are experiencing or what we are analyzing through auto trader, we want to discuss those things with you, so that if in case you need that analysis in future, you may be able to do it independently. So auto trader is not for direct calls, and please do not expect any direct calls on auto trader. So this is how our auto trader support channel looks. For those who have not really joined our channel, I will come later on to how to join this channel when we land up on our homepage of the auto trader. So by till that time, you can see that how we give you certain kind of inputs on how to take the trades, how to analyze small things, so that your overall understanding of the market improves, and it in turns is helpful for your decision making. So this is what the second screenshot looks like. Now coming on to the flow of the webinar today, I'm expecting this webinar to be over by 8:15, 8:30. It will be a little lengthy kind of a thing because I will discuss everything in detail, and for the better understanding of many of you who are not really taking advantage of this software in true sense. So first of all, we will cover market analysis. We will see how few inputs will give you a better understanding of how the market will be behaving in near future. Then we come on to understanding the open interest. What is open interest? How we look at the open interest? What all we have given in our auto trader. Then we'll come to option analysis. Option analysis, we'll discuss PCR and difference data, how it impacts the overall understanding of the markets. Then we'll move to the future part, future price action, how it is integrated into the option analysis to give you a complete analysis. Introduction to VWAP is important just because it helps you take the stop loss decisions. It helps to identify the overall trend in the market through future price actions. Then we will understand how to take index trade, what will be the strike price, what will be the SL target, trail SL. And then after all this, we will discuss today's trade and how we analyze that the market is going up or down through a very constructive analysis. And then we'll recap and finish the webinar after Q&A session. So before moving further, I would like to discuss some of the terminologies which are needed for you to understand. First thing is derivative segment. Many of us, I would rather say that, think that option analysis is equal to derivative analysis. No, option is a part of derivative segment, and when we combine future segment with option segment, it completes the derivative segment. So first thing first, you should be clear on that. Strike price is the price at which a call or a put option can be exercised. So this is a simple definition, nothing more than that. You are well aware that in the market, if today the spot price is 17,000, you can easily go and trade in 18,200 call option or 15,800 put option. So that is your choice, and exchange has given multiple options for the strike price where you can trade. Open interest. What is open interest? Open interest is the total number of open derivative contract that has not been settled. What that means is that if you have shorted a call option and you are still holding that call option on a short side, you have not closed or you have not taken a counter position, that means that is open and you have created an open interest, or your open interest is still open. So that is the thing. Change in OI, change in open interest or change in OI is that any fresh position opened or closed today. Fresh position may be on the call side or put side or on the sell side or on the buy side, which is closed, open or closed for today. We are talking just for the intraday purpose. We are not talking on cumulative terms. Volume traded. Volume traded indicates the total number of buy and sell transaction happened over the period of time. So many people, what they do is they confuse the two terminologies. Volume traded is a different thing and change in OI is a different thing. So you should keep in mind both these things. Both these things are different, and we will come to the point that how it is different. PCR is your put call ratio. It is put writing divided by call writing. I will make you understand that why it is put writing divided by call writing and not put buying divided by call buying in a later stage. Difference is nothing but put writing minus call writing. That means whenever you subtract put writing from call writing from put writing, it gives you a difference figure. It could be negative, it could be positive. That we have to analyze that when it is positive, what is the implication, and when it is negative, what is the implication. So This is the thing. Option selling and option writing is one and the same thing. Whenever we say that option writers are active, we are referring to option selling only. You may have listened to many anchors, or you may have read on many platforms that call writers are more active, that is why the market is going down, or put writers are more active, that is why the market is going up. So it is basically referring to the selling in the market, option selling in the market. Addition is any new contract which has been added into the market. Unwinding is any position which is closed. You have a open position previous day and you have closed that position today. That means you have unwinded your position. And last but not the least, VWAP is volume weighted average price. There is a concept of average price, and when we combine the volume onto that average price concept, we have volume weighted average price. We will discuss it little later, but for the sake of terminology, you should know these terminologies. So this is how the option matrix looks like. Whenever you buy a call, that means you are bullish on the market. And whenever you buy a put, or you are taking a long position in put, that means you are bearish on the market. Okay, that much I think you are able to understand, or you already know. Okay, but when we sell or write the call option, either we are bearish on the market or we are neutral on the market. Understood? Or when we write a put, we are bullish on the market, or at least we are neutral on the market. We are not really bearish on the market. So you need to understand this whole matrix to really make sense of how we analyze the markets. So now we'll touch upon the concept of open interest. So open interest is like, if there are 5 players in the market, so every market participants, either he is a buyer or he is a seller. Okay, so you can see that here Anuj has taken a long position of 7 lots, whereas Kshitij had short sold 9 lots. Dhiren 12 lots he has taken on a long side, whereas Ajay and Ravi have taken short position in 2 lots and 8 lots. That means on a combined basis, the open interest, the total open interest is only 19, because they have not really closed their positions. So open interest is any open position which is not being settled in the market. So in total, there are 19 open position in the market on a combined basis from the buy side as well as from the sell side. Okay, so combined 19 positions. So let's move to our software and check how we can take advantage of the software to analyze the markets. So as you can see over here, that there are many inputs given. Some of the inputs are from the stock perspective, and certain inputs are really to make you understand the market movement. So initially you can see we have given you Nifty spot and Bank Nifty spot index, which you can refer any which ways. And then if you can closely see that there is Nifty data indicator and Bank Nifty data indicator. So these two data indicators are suggesting a future data trend. So how data is developing on the future side. We have done certain calculations at the back end and presented you with this figure. So, so whenever you are on the system, you should take into consideration that markets are dynamic and you need a proper checklist. You cannot just rely on one particular aspect to really take your decisions. You have to consider lot many things before arriving at a proper, well-informed decision. So this is the first indicator which we are referring to. Here you can see that Nifty data indicator has a positive value. That means from the perspective of future data in Nifty, it is suggesting a positive trend, whereas Bank Nifty data indicator suggesting a negative trend to the tune of 9,71,925 quantity. So this is one basic thing. This is an initial indicator. The second initial indicator which we are providing you over here is the market balancer. So market balancer has a very important role as such because it gives you the data for the stocks, how the data is spanning for F&O stocks. Look, the thing is that market cannot move in isolation. Market will move either positive or negative just because the stocks which make up the market moves either on the downside or on the upside, right? So this market balancer is much more important to that sense that if it is highly negative, then markets will be negative. And if it is on a positive side, then markets are likely to be on a positive side. Here you can see that today, even though the market gapped up, we'll see later on how the market balancer changes trend, and eventually we have this figure at 330. Market balancer 134 stocks out of a gamut of 190 stocks or 195 F&O stocks. 134 stocks have a negative data, whereas only 30 stocks have a positive data. This means that market in true sense is on a negative side. So this is the second checklist. It is very much similar to your advanced decline ratio. So how advanced decline ratio works, on a similar pattern, your market balancer will also work. So now this is the second initial indicator. Then the third initial indicator is your index. Index, I'll quickly so now So the third initial indicator is your index sentiment. Here you can just look at the initial indicator, whereas all the indices, major indices, be it auto sector or private banking or energy or FMCG, are all on the negative side. So why it is important? Because index has stocks. So like if you consider Maruti as a stock, then it belongs to auto sector. If you consider HDFC, it belongs to private sector banking. Reliance is in energy. ITC HUL is in FMCG. TCS, Infosys, and every other IT stock is in IT sector. So when these will not perform, these sectors individually or collectively not perform, then how can you expect the markets to be bullish? So for the markets to remain bullish, or or the markets to be on a downside, these indexes has to move either way. So this is very important indicator on an initial level. The third, this is the third. Now I'm coming on to the fourth indicator, which is slightly positional, but then it has its own space for you to understand the market. It is known as midterm checklist. Trend midterm checklist. It is for the positional. It is not for the intraday purpose. It is just for the positional aspect. Why it is important? It is important just because of Nifty bulk average and Bank Nifty bulk average. What it suggests is that till the time Nifty doesn't cross 17,576 level, market is on sell on rise mode. Market is positionally bearish. Tomorrow, it might be possible that due to certain factors, you may see a relief rally kind of a thing. But then also, from a positional perspective, you should look at these levels. For Nifty, it is 17,756, and for Bank Nifty, it is 40,767. So these are certain initial indicators from which you can just have a sense that market is positive or market is negative. Nothing more than that you can arrive. So to trade in the market, you need three things. One is your market trend. Market trend comprises of three questions, three basic questions. One is whether the present trend, will it continue the same way, or it will trend. The second thing, it may reverse, or third thing, it may consolidate a bit. Many times it may be possible that market gaps up by 100 points and throughout the day it remains in a tight range on a positive side. Certain days it happens that it gaps up by 100 points, it strengthens itself and goes up to 150 points or 200 points. So this is trend, the present trend being continued. The third thing is that, as we have seen today, that what happened, market gapped up because of the global factors, because of the Asian markets and some bounce in the Dow Jones, but it did not sustain and continuously it kept on going down and eventually ending up below 17,000 for a very large part. It remained above 17, but later on, due to certain pressure, it went down. And Bank Nifty, even though it managed to stay above 39,000, but then also it is some kind of a weak market. So we'll discuss how we can analyze the trends in the market. For that, we need to go to advanced level theories, and one of the advanced level mechanism is on the homepage itself, which is option data indicator. Option data indicator is one of the advanced level concepts which we have given on the homepage. It simply gives you a very good picture for the money flow. So as you can see on the left hand side, you have option data indicator for Nifty call option. And on the right hand side, put option data for Nifty is being populated. So here you can clearly see that money has been withdrawn from 17,100 call option, 17,200 call option, 17,300 call option, and 17,400 call option. So money outflow happened in calls, and it happened throughout the day, right from the beginning. We will discuss these things when we take up today's trade and analysis. What was there in today's data and how we identified that we want to go that way. So we'll come to that later on. Similarly, if you can see that on the put side, there was a lot of money flow. That is why it has a positive data to it. So this is one of the best indicators on how you should be viewing the market, and sometimes it is also good for you to select the strike prices. Okay. Just hold on for a minute. Okay, I have a suggestion that to use a white background. So I am switching on the white background. It is much more easier for many people to understand. I hope now it is clear. Fine. So I'm taking this example from the Nifty point of view. The same concept you can apply. The same concept you can apply for Bank Nifty, for Fin Nifty, and even for the stocks. The concept remains the same. The application on different platforms may differ. Okay. So first thing first, we have divided this whole section into three parts. One is the first part is the option analysis. Here you can see this is the first part, the whole option analysis. The second part is your intraday data. Here you can see intraday data. And the third part is your charting. Why charting is important? It's just because it gives you a very good visual appeal. Visual appeal is quite important to the fact that it is much more easier to understand. Sometimes if I give you figures to analyze, you may not be able to take account of that. But when you see the charts, it is quite simple. As you can see over here, this is red line is a zero line. For your benefit, we have given zero line just because you can easily make out the difference between when it was positive and when it is negative. So for Nifty, you can see at 9:30 it was slightly positive, and then at 10:30 it was just about closer to zero line, and then suddenly it went down, 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 and eventually closing the session at day low. Whereas for Bank Nifty, you can easily see that right from the very beginning of the session, it was on a negative side and it never came up, never shown any signs of reversal. And it continued down side movement till 14:30, and eventually it closed well below the zero line. And it is quite acceptable that when the market is weak, then the option data will be below zero line. So now coming on to the other aspect, if you have not noticed, we have given you Nifty OI charts. Nifty OI charts is the this is the bar chart of the OI concentration for the week. If you want to take a positional bet on the market, this is the chart you can see. Here you can see that 17,100 has a lot of call writing. 17,200 has a lot of call writing. Even 17,000 level has a call writing. This data is for the current week, which will expire tomorrow. So why I am telling you that it is a writing data, we'll discuss when we discuss the whole table. Till that time, you just concentrate on the charting thing which we have provided. This particular data is for the change in OI. So change in OI happened today. Today is the intraday data. So what you can see is that 17,000 put option has a unwinding data to it. Unwinding means that people have reduced their positions. Similarly, 17,050 put option, there was a slight increase in 17,100 put option. Here you can see. So coming back to this thing, you can see that it is pretty much evident that a lot of call writing happened, and it has happened for good, and market went down very smoothly, very easily. You can make out that market is not in a mood to give you a clear-cut bounce back. So this is quite evident from this chart. Similarly, for Bank Nifty, we have given the charts. Nifty monthly table we are giving, monthly data table. Monthly expiry happened on 29th of March. So you can have a look at these data also if you are looking for a positional bet, or if you are interested more in strategy trades, you can easily look into these things. Other than that, same Nifty OI charts and Bank Nifty OI charts is available to you. So coming back to our discussion, which is most important discussion. So first half presents you with option analysis. Whenever we discuss the derivative segment, we discuss both the things to have a complete scenario, to have a complete analysis. That option analysis forms one base, and when we combine that option analysis with our future analysis, then it becomes a complete analysis wherein no segment is left out. Okay, what some people do is they give more importance to option analysis, and some people what they do is they give more importance to future price action. But in derivative or quant analysis, we give proper equal weight to each segment. Since option analysis is little harder or little complex to understand, that is why we give more importance or weightage to option analysis, because what we don't understand or what we think that it is harder, we attach some little more importance to those things, but it is not the way. So let's begin with what is over here. So simply the in the middle you can see the strike prices ranging from 17,500 to 15,900. No need to have a proper explanation of what is strike price. You may already know what is what is a strike price. The second thing which you can see over here is the last price. Last price is indicative current market price, which we give you for the reference purpose. Nothing more than that. The thing is that when you want to trade, you will surely have to look at current market price on your execution platform. So it is just for your reference, just for your understanding. So like 17,300 call option at 330 was running at 4 rupees and 60 paisa. Okay. Similarly, you can look over here that 17,200 put option was running at 234 rupees and 70 paisa. Right. So this is just the current market price, nothing more than that. The second thing is open interest. Open interest, as I have discussed, it is all the contracts which is not been settled. So we are giving you a cumulative figure for the open interest from the day the contract started till today. So every contract starts not from the day the current week starts, but some 3-4 weeks back. Like today, you can go and trade in April month's contract also, weekly contract also. So similarly, some day this current week also might have started. So all the open position on a cumulative basis, which has been traded in this series, whatever open interest has been created, it is displayed over here. Why it is important is just because it gives you your resistance level and your support level. How it gives us that particular thing is that we have highlighted it in yellow. If I can just change it would be much more easier for you to have a look. At 17,200, there is a yellow highlighted open interest, which is the highest open interest among all these strike prices. So that becomes your resistance point. Similarly, if you look at the put side, what you can see is 59,30,650 open interest is highest open interest on the put side. So it becomes an immediate support for you. Earlier, it was 17,000. But due to certain selling pressures and unwinding in 17,000 put option, it shifted base from 17,000 levels to 16,900. So now new support is 16,900. Similarly, what data suggested that call option open interest also shifted from 17,500 to 17,300 and then to 17,200. So this is the pattern which we follow. So I'll quickly change the color. Okay. So by now you must have understood that why it is important to know cumulative open interest is just because it has resistance and support. And why resistance and support is important? For two things. One, for your basic understanding of the market. And second, when you are trading in the market, you should be knowing this fact that whatever be the case, whatever be the reason of the market fall or market rise, you should not attempt any fresh position near support or resistance. No matter how the market looks to you, very weak market it may be sounding, but you should not be taking any fresh position near support. It may end up trapping you in a situation where you end up paying more premium and more pain. Eventually the things might follow in your direction, but then it may be a very painful session for you, or sometimes it may cost you your stop loss. So remember that no position should be taken near support or resistance if it is a fresh position, or if even if you are holding an existing position, you should look to liquidate your position near support or resistance. That is it. The third thing over here is your change in OI. Change in OI reflects the mood of the market today from the intraday perspective. So you can always see that call addition, open interest addition is reflected in on the green side, and open interest unwinding is reflected in red or a negative sense. So on a cumulative basis, if you look at every individual strike price, you will find some kind of open interest addition, or on an individual basis, you will find certain unwinding happening. Like you can see at 17,250, round about 1,59,900 contracts were closed today. Whatever little open interest was there in 17,250 put option, now it is a negative figure to the tune of 1,59,900. Whereas you can see over here 17,250 open interest being added to the tune of 31,58,850. So this is a huge difference, right? And now coming on to a very big question which many people fail to understand is that why our option analysis is known as a contrarian analysis, or it is known as a seller's market. Why it is known as a seller's market, or why it is known as a contrarian analysis, is just because whatever open interest you are seeing on the call side or on the put side is from the perspective of a seller. And why it is from the perspective of the seller is just because in option trading, I repeat, in option trading, only the seller takes the risk. Buyer is nowhere taking any risk. He is taking an insurance. He is just paying the premium and booking sufficient losses in his book at the start of the contract. And the one who is taking the entire risk on his shoulders is the seller. But when we come to the future part, then both the participants on a future contract take equal amount of risk. Why equal amount of risk is that whenever in future a contract happens at 100 rupees If I am the buyer at 100 rupees and you are the seller at 100 rupees, then if the market goes up, then I will benefit at the same time, and at the same time you will lose. Further, if the market, if the price falls, then you will start making profit and I will start making losses at the very same time. But in option, what happens is sometimes the seller has a delayed loss proposition because he receives the amount upfront, and if the market doesn't go his way, then only he will end up losing money. Otherwise, if it is a neutral market or if it is a consolidation market, he will eventually make money, the seller, and the buyer will lose money. Or if the market goes in his direction, then he will make money out of it. So all the risk is been taken by the seller. So that is why this whole open interest scenario is from the selling perspective. So you can see over here 17,250 call writers are active. Call writers to the tune of 31,58,850 were active today, and the cumulative figure was 5 crores 50 lakhs. Okay, so that is the difference. Oh, sorry, not 5 crores, it's 55 lakhs 2,750. So that is the thing. Okay, so if the call writers are active, so in change in OI, what we do is, from an intraday perspective, what we are trying to find out is whether the call writers are active or the put writers are active. If in case call writers are active, then what market will do is it will attempt to go down. The probability of market going down in case there is a call writing happening is more. I am just suggesting a probability. It's not a guarantee. It's not a short thing. It is always a probability that if call writers are more active than put writers, market will go down. And if it is put writers are in majority, then call writers, then market will go up. So throughout the day, we are analyzing this fact only. Just look at that. It is a 330 figure. Throughout the day, we are analyzing this thing. If call writers are active more than the put writers, as you can see over here on a cumulative basis, it is 3 crores 26 lakhs 34,200. And put writers on a cumulative basis is what? It's hardly 15 lakhs 200. So there is a huge difference between what call writer is doing and what put writers are doing. For now, for the sake of understanding or for your own benefit, we have given you intraday data. So here you can see this data and this data is matching, and this data and this data, put side data, is matching. Why it is matching? It's just because it is a 330 data. So what we have done over here is to make you understand the trend of the market or make you understand how the market is behaving. We have given you data every 15 minutes, as you can see over here, right from the 9:30 slot to 9:45, 10 to 10:15, 10:30. What we have done over here is that at 9:30, we have taken the situation, or we have taken the open interest for the call option and for the put option, and we have displayed it over here. Why it is important is just because now we will take out the difference and the PCR for the same and try to analyze the market at every 15 minutes and how it is progressing. So here you can see that at 9:30 call writers were 17.9 lakh 60,000, whereas put writers were 98 lakhs 25,950. So it gives me a positive difference of 1 lakh 86, sorry, 18 lakh 65,950. As we have already discussed, what is your difference data and what is your PCR data, I'll quickly move on to what you should analyze with respect to the PCR. So whenever the PCR is above 1, then market is supposed to behave in a positive way. Okay, just because your put writing is more than call writing, we expect the market to be on a positive side, right? So that is the thing. And whenever the market is attempting to go in a sell direction or attempting to be weak, then obviously the fraction of put writing divided by call writing will be below 1. As you can see over here at 9:45, what really happened was call writing in just 15 minutes, it shot up from 79 lakhs 60,000 to 1 crore 48 lakhs. So this is the huge difference. Even though call writing, put writing also increased, but it is not with the same proportion. It merely increased from 98 lakhs to 1 crore 39 lakhs, resulting in a negative difference and a PCR value of 0.94. Whenever we divide put writing by call writing, it gives me a figure which is below 1. And below 1 means you have an option sell. So now coming on to how to identify the trend from the PCR, right? So I'll give you one Excel analysis of that. I'll quickly share the Excel workbook. Here you can see. So you have to analyze the PCR to make sure you understand the market movement. So if your PCR is really going in case 1, if your PCR is at 1.2 initially, then it goes to 1.4, it goes to 1.7, it goes to 1.9 and eventually 2.2. That means it is an increasing order. Now the market over here, or what we are understanding from this PCR is that every time put writing is strengthening itself and it is much more than the call writing from the previous reading. So previous reading may be 5 minutes or maybe 15 minutes. It all depends on your aggressiveness to look at the markets. Okay, so now this is the case 1. Here you can expect the market to go from plus 30 points to 60 points to say 80 points to 100 points to 150 points up. The second case is market reading is 0.8 or say 0.9, then it slides to 0.7, then it slides to 0.5, 0.3, 0.2. So it gives me a sense that market is strengthening on a weaker side, on a downward side. So in this case, market may open 50 points minus. It eventually gets down to minus 80 points, then minus 100 points, then minus 140 points, or minus 200 points. So this will be the trajectory if this kind of a trend you will see. So I'll discuss how we can set the trend. The third case is obviously the reversal trade from positive to negative. So how from positive to negative? So 1.5 it opened, then 1.2, then 1.1, then 0.8, then 0.7. This is going from positive trend to negative trend. Okay, so market may open 100 points up, then it comes down to 50 points, then comes down to 20 points, then minus 30 points and minus 100 points. Okay, so this may be the scenario. The fourth case is just opposite of it, that from negative to positive. So 0.8, 0.9, 1.5, 1.7, 1.9. So this scenario changes from negative to positive. So markets may be minus 30 points down, then minus 10, then 30 points up, 50 points up, 90 points up. So this is the fifth case. Fourth case. Fifth case is negative consolidation, a positive consolidation, and sixth phase is your positive consolidation. So how it is a positive consolidation? So market may open 1.2, certain gap up opening, or a positive opening 1.2, and then for the entire day or the entire section, market just doesn't move anywhere. So the PCR also doesn't move anywhere, and it is 1.8, then 1.23, then 1.15, then 1.25. So this is a positive consolidation. Then the negative consolidation is what? 0.8, 0.75, 0.77, 0.72, 0.7. So this is a negative consolidation. So you need to analyze the PCR data just to make sure the trend in the market. So today what happened was, the market data was initially positive for Nifty. Then it went down. It touched 0.9. It again went back to 1.01. At this time, till 10:30, there was a slight understanding that market may be negative just because your future price action was suggesting a negative tone. I will come to this analysis later on, but then you should understand that how the PCR was also making sense that market is going down. So by the time 10:45 came in, it was 0.89. And to make sure that you don't trade or you do not attempt to trade before 10:30, we have given an advisory that use this data after 10:30. So 10:30. 10:30, it is 1.01. At 10:45, it is 0.89. Then at 11.73. So you can easily make out that it was a case of, it was third case, wherein it started on a positive note and then eventually succumbed to selling pressure and eventually going down very heavily. So you can clearly see over here the slope of the PCR. So slope of the PCR is very important to, and this is what slope of the PCR looks like. There was a positive opening, then there was a slight negativity, consolidation, and then eventually giving the whole flow in the market. So I have taken a lot of time on making you understand the PCR data. So one thing is pretty sure, that option signal will be sell whenever the PCR is below 1, and option signal will be buy whenever the PCR is above 1. So on two instances today, at 10:30 and 9:30, the PCR value was above 1 and option signal was buy. Now coming on to a very important thing, which is future price action. And here I will introduce the concept of VWAP. I've already told you the basic bookish definition of VWAP. Now we will come to a more elaborative definition. So what is VWAP? VWAP is nothing but volume weighted average price, as you already know. But what is its implication? Well, I'll quickly take you to the Excel sheet. So simple average is what? Simple average is like price moved from say 17,300 to 17,270, 17,240. So now the simple average is what? Divided by 3, which is 17,270, right? This is the simple average, but it is nowhere stable, just because if you add another figure to it, say 17,200. So this figure will quickly change to 17,250. Previously it was what? 17,270. Now it is what? 17,250. Okay. Now, how VWAP is more stable, or how VWAP changes the equation is, you can look at, say, if I add lots to it. So what is the volume traded on every price point? Say at 17,300, there was 30 quantity. This is QTY. This is price. At 270, there was say 70 lots. At 17,240, it is say 90 lots. So initially, what will be the average? Initially, the average would be 17,260. Now at 17,200, suppose say 150 lots traded. So how the VWAP changed? It changed from 260 immediately to 17,233. Whereas when we take the simple average into consideration, it hardly dropped from 70 to 52. Nothing more than that. No importance to the volume being traded. So volume adds effectiveness to the whole situation. So here we see that VWAP is much more stable concept, and whenever we compare VWAP, we have to take into consideration the future price. Why we are taking future price for the consideration is just because you cannot have VWAP for spot, because spot is hardly traded. It is not traded actually. So derivative is being future is being traded, and VWAP happens to be of the future, and that is why we are taking future price for our reference. So whenever the price falls below the average, that means it is on a weaker side. whenever we say in the routine way also that markets are you are below average or you are above average, we are referring to the strong or the weak factor of the subject, right? So here also you can see that right from the very beginning in the of the market, the VWAP was at 17,243, but the actual price was at 17,221. So that is why it is suggesting a sell. Okay, that is clear. So now you have to combine both the things. One is the option analysis and the second thing is the future analysis. Future analysis, what we have given, VWAP analysis, right? So I am taking an example from a every 15 minutes perspective. But if you are an aggressive trader, or you can manage your position in a better way, and you have a aggressive nature, you can also look at 5 minutes. But I would prefer that these days markets are highly volatile and it is not recommended to go for 5 minutes. 15 minutes is much more stable and gives you a very good signal strength. So as you can see, if I take 5 minutes into consideration, there are lot of buy signals being generated. Okay, so just to make sure that you avoid these situations, you take 15 minutes. And as a beginner also, I would rather suggest you, or as a conservative trader also, I would rather suggest you to take a balanced approach and give time to the markets. 15 minutes is quite sufficient time. Okay, so this is how the whole option analysis and future analysis fit into our market analysis. So from combining these two things, we could be pretty sure on two things. One, the trend of the market and where the market is really going to be in the future. Future may be intraday in our case, but it is eventually the future. So if you are looking at the market at 11 o'clock, then we will predict how the market will move at 3:30 or at 2 o'clock or at 2:30. So this is very important to just to make you understand everything. So now coming on to the very important question as to whenever we have identified the trend, how to take the trade and what all points we need to understand, or what all points we need to keep in mind before taking any decisions. So now coming on at 10:30, remember to use this tool after 10:30, right? So at 10:30, before 10:30, you should sit back and just watch the market. It is similar to the fact that even best of players in the cricketing world, if they are playing a test match, what they do is they bat for at least an hour before they can really open up to play aggressively or to play comfortably. So first hour is very important in the test match. Same way you can think of market as a test match and play out the first hour. So after 10:30, things would be much more clearer. So here you can see after 10:30, you see a buy signal on the option side and you see a sell signal on the future side. So now what you have to do in this case, when there are conflicting views, you have to wait and watch for the next move. Okay, so next move. But by the time you hit 10:30, you have a lot of back reference from 9:30 to 10:30. So you can easily make out that it is not right for me to take a bullish position. Look, just by looking at the data. Why? Because the initial data was 1.23. It went down to 0.9. And for some or the other reason, it went back to 1.1. Whereas my future data is suggesting me a complete sell. So I don't want to take a bullish position and trap myself, right? So this is one thing you should make it very clear. So by the time 10:45 comes, your PCR drops to 0.89. That is a very good sign. And it is a sell. So you are now ready to take your decisions. So what all decisions? You see a price of 17,171. So remember this thing, that if you are trading on Friday, Monday and Tuesday, these 3 days, if you are trading, you have the liberty to take either one at the money put option, at the money option, or in the money option, one in the money option, one strike price higher and one strike price lower. That combination is known as close to money. So whenever you are trading on Friday, Monday and Tuesday, you have the liberty to choose any strike price from close to money bracket. And if you are trading on Wednesdays or Thursday, specifically on Thursday, you have to compulsorily take at the money or near to at the money strike price. Okay. So now at 10:45, you have a situation where the market is bearish. So what you can do is you can either write a call, right? That is one way of playing the bearish mode. Then you can short the future. But the problem here is, in both these cases, shorting the call option and shorting the future, you need margin money. And if you don't have enough margin money, the simplest way is to play with puts, right? That is quite sure. And many of our retail clients do the buying of options only. So for the sake of this example, I'm taking an example of put option. So what is the strike price which is closer to the current market price, which is at 17,171? It is 17,150 put option. So this is the at the money. Why I am not taking 17,200 is just because it will be slightly in the money. So here I am referring to at the money. So 17,150 would be quite good. And it also correlates with the fact that spot happens to be closer to 17,150 at that time, because all the option expires in relation to your spot price. So we have to consider that also. So now you are clear with the strike price selection. Now moving on to your stop loss. So in the stop loss, what many retail clients do is they take the stop loss of the option pricing. So many a times what big players do is they hunt their stop losses, or they try to take the price closer to your stop loss, or they make you play in that sense that you panic and liquidate your position, and then from there they eventually take the ride. So to solve this problem, what we have identified is that don't take any stop loss from the option pricing bracket. You have to compulsorily choose the stop loss from VWAP perspective. So VWAP is a stable average, and you have to give a flexibility to VWAP. So many a times what happens is price tends to come closer to VWAP and then again goes in that direction which it is already been continuing. So taking a stop loss of just VWAP is not advisable. You should always take a stop loss which is higher than the VWAP in case you are taking a put option, and in case you are taking a call option, then you should place your stop loss below the VWAP. Okay, understood? So by normal understanding or normal market behavior, 30 to 35 points above the VWAP would be your stop loss in case you are taking a bearish trade, in case you are taking a put option. So now your VWAP was 17,224 at 10:45. So if I add 35 points, which would be roughly around 17,260 future level, my stop loss would be 17,260 levels. From the future perspective, I'm okay with it. Okay, now I'm not worried about where the option pricing is going. I'm more worried about 17,260 as a future level. I have to watch out that level, and if that level in the future gets stopped out, then I'm also out of the market, right? So I'm ready to book losses and get out of the market and look for the next possible opportunity. Till that time, I'm in the trade. So now two things are sorted out. One is your strike price selection. Second is your stop loss. Now coming on to the very basic question, what will be the target? So target we can define in two ways. One is any support or resistance can be your first target. Second, whenever your option price increases by 50%, that means if you have taken the option at 100 rupees, whenever it reaches 150 or more or 160, your first target is complete. Or the third way out is that you can define a target for your own self. That is quite indicative. Like you are the boss, you can always choose your target. So I'm not really there to give you a strict instruction that this is the stop loss. You have to manage your position, you have to manage your risk, so you have to manage your target also. These all things are indicative in nature. Okay, I'm just trying to explain what you need to do. So now all these things, three things are sorted out, and you are open to go in the market, take the trade and benefit out of it. Now, then what about the trailing stop loss? Once the first target is hit, then your trailing stop loss can be your cost. Cost would be the option pricing. This is the first time I'm referring the option pricing as a basic stop loss. Basic stop loss means like trailing stop loss. Sorry, not basic stop loss, but trailing stop loss. The second aspect to the trailing stop loss is that you can, once you are in profits, then you can always take VWAP as your trailing stop loss. So every time your VWAP reduces itself, like here you can see it goes from 17,224 to 17,190 at 145. It again goes down to 17,164 at 315. So you can always mix and match and do your trade. So this will eventually help you take a very good decision, right decision, and it will also enhance your productivity. Now coming on to, this is all from my side. This is about the whole training on how to use the auto trender to identify a quality trade, quality index trade, and also identifying the market trend. Now I'll quickly take 10 minutes of your time and explain today's trade and how it happened. So here you can see that, look, at 10:43 a.m., what you see is that my market balancer. This is the market balancer. Market balancer was 100 to 55, right? But the interesting thing at 10:45 was that option data indicator was suggesting that money is being thrown out of the call option and money has been put into put option. You can clearly see that there is a huge negative figure of 3 crores 99 lakhs 46,600. It suggests the market participation in the call side as well as the put side. Put, you see that there the quantity is roughly to the tune of 2 crores 60 lakhs 6,250. So money flow is being distributed in that way. One more thing you can see here is that call writing was at 79 and put writing was at 330. Your support, your resistance was at 200 and your support was at 17,000, right? At 10:45, at 10:30, your PCR was above 1, so you need not to do anything. So this is the thing which will suggest you that even though the market is negative, but then also you need to wait and watch. Now coming on to the second slide, if I'll do that. Now look, market balancer in the previous slide was 100. Now the market balancer is 89 to 59, right? And just look at the flow of money in call option and put option. Flow of money is aggressively negative. Previously, what it was, sorry. So previously what it was, 3 crores 99 lakhs. Now it is 4 crores 91 lakhs. And similarly, it was 2 crores and 60 lakhs on the put side, whereas it is 3 crores and 15 lakhs. Market was still positive. Now look over here also. Call writing increased from what? From 79% to 88%, from 74% to 76%. But there was hardly any change in the put writing. Data was turning negative. So this is how you analyze the things. Now again, at 11, what happened was, there was, you can, in the price action, there was no such change. As you can see over here, that 17,171 and 17,170, there was hardly any change. But if you closely look at 4 crores 94 lakhs, 3 crores 67 lakh, there is a change. From 88, the call writing jumped from 88% to 103%, 84%. Now the unwinding happened in put option. Earlier it was, in the earlier slide, it was 380 and 1112. Now it is 349 and 84. So call writing happened and put unwinding start happening. Here you can see again the similar pattern happened at 11:15. Further unwinding happened. Look. So you are pretty much sure that this trend will continue for sure. Eventually, you may see further deterioration of market data. At 1 p.m., what happened was the PCR also dropped from 0.58 from 0.6 to 0.58, and there is hell lot of a mayhem in the market. So call writing was to the tune of 100% and 140, whereas there was a huge unwinding from the earlier position. So this is how you identify the trend, and this is how you should look at. So what happened today was, you can simply look at over here. So at 10 a.m., if you look at 10:45, this is the price point. Okay. 17,150 put option was running at 83 rupees, right? 87 rupees. And by the time the clock hit 2:30, by the time clock hit 2:30 over here, it was already trading at 125 rupees. And if you have waited a little longer till say 3:15, it almost touched a high of 205. So this is how Auto Trader will benefit you in identifying the trades and eventually executing the trades in a very logical manner, in a very supportive manner. There was no panic in the market. If you are looking at the data, this data, and executing your trades, it is so simple and it is so easy to trade with the support of Auto Trader. So this is all from my side. Now a quick question and answer session before we wind up the session. Thank you very much. Thank you for patiently listening me for almost 2 hours now. So thank you very much. Thank you for participating.